As a great scene setter for the next session. We're going to talk about capital and innovation in a changing world, and we're going to try and answer the question about how investors are allocating capital to AI, digital infrastructure, and the energy transition without any compromise on resilience or trust. And I'm delighted to have a top series of panelists to discuss this. To my immediate left, Bettina Orlopp, CEO of Commerzbank, 155 years old. At the end of the panel, we have Rishi Khosla from OakNorth, 10 years old. That's only the third bank in Britain to get a license in the last 150 years. I think that's right.
At the time we got it, yes.
Yes, at the time we got it. And in the center, Mohammed Al-Hardan, the head of technology at the Qatar Investment Authority. So I want to just get a bit of a scene setter here about how investors are currently allocating capital in this very volatile world. You don't have to go very far back this week to see the level of volatility that investors are having to cope with. I did a panel yesterday morning with a group of chief financial officers, and I calculated their market capitalization, cumulative market capitalization, and announced that we were sitting around a table with $1.5 trillion worth of market value. And one of them said, were you measuring that last night or the night before? Because they obviously had, at that stage, lost a lot of market value in the turbulence. But Bettina, let me turn to you first. What do you see from where you sit in Germany about how investors are going about making those crucial capital decisions now?
Yeah, I mean, you're saying it already. It's coping with volatility is probably key, and you need to have really good nerves sometimes. Beginning of this week was clearly the case, and that it's always interesting to see how fast markets can recover again. But when it comes to a little bit more midterm thinking, it is clearly it's all about diversification in the moment. That's what we get as a feedback. That you can also see in when you take the re-rating of the European banking, which you have seen over the past year, 2025, that was already the beginning. There is an increased interest into Europe, which we haven't seen for quite a while. And it's not only banking, but it's really broad-based. And we just had our own investor conference with German clients, German corporate clients, DAX, MDAX, last week in New York. And then we had 400 investors there, only North American investors. And there's a huge interest in Germany and in Europe. I can see it myself when I'm sitting in investor meetings and I want to talk about Commerzbank, and then I spend basically half an hour about Germany, Europe, macro. Might be also that our profitability has much increased, and it's boring to talk about our performance, which is probably good, but it's you see there is lots of interest, and if I have to pick sectors, nobody will be surprised that clearly tech is important. Defense, in our case for Germany, is super important. Everything around infrastructure and energy, that are the key themes, and there are some industries who probably have a little bit less interest in the moment for obvious reasons. And I think we need to take this opportunity, for example, as Europe. But I also have to say that there is an unchanged interest also in when it goes about investing. When I take corporates, they're very much interested in investing in Asia. They are interested still also in investing into the US, because the US is a very, very big and important market for Europe, and that is not changing. So it's very, very broad.
Right. We'll talk a little bit later probably about capital allocation and what has shifted. Clearly, I'm hearing a lot more here at Davos and elsewhere about not just about China plus one for supply chains, but about USA plus one for investment and customers. Rishi, contrast and perhaps compare with what Bettina's laid out as some of the capital allocation priorities that she sees. What do you see from your perspective?
So we have a very different angle on this, because as an institution, we focus on supporting and funding entrepreneurs, and really entrepreneurs who are scaling up their businesses, both in the US and the UK. And I'll talk a little bit about both that dynamic, but also the difference between what we experience in the UK and the US. So first, the thing which I'd say about entrepreneurs is that great entrepreneurs always find opportunities irrespective of sort of the environment. And sometimes actually in the hardest of environments, you get the best companies built, because in a way you need to build and scale with discipline in harder environments than when capital is flowing incredibly loosely and the like. And through that, what we've seen is that there are clearly certain trends which are happening where you can say that, you know, there's housing shortages in certain countries. There's sort of the desire as younger generations drink less, and actually when they socialize, they want to spend less time on devices. Actually, sort of saying, how do you look at competitive socializing and the like, and sort of the build-up of different segments of industries which are happening in a very real way today. And so we experience that happening in volumes. And then the difference which we see between the UK and US, where we operate, is that the UK entrepreneur is still much more cautious in terms of making investments, is much more, how can I put it, not as front-footed. Whereas in the US, just the velocity and the appetite for risk-taking and sort of expansion is just so different. I mean, just to put that into context, we've been operating for 10 years, and we've only been in the US for 3 years, but yet we did 40% of our new volume in the US last year. So that just shows like the velocity which you get with the entrepreneurial energy which you have there. And I think that almost exists in any environment. And as I said, more so almost in harder environments.
Thank you. Thanks. I mean, there's sort of necessity is the mother of invention part of that, which I think is obviously true everywhere. Let me ask Mohammed if you could come in, and perhaps you could start just by giving us a brief overview of what the QIA's mandate is and how it's being rolled out.
Sure, I'll give the executive summary, but I'm sure there's a few of you who are less familiar than QIA and how QIA is different vis-a-vis the other sovereign wealth funds. I think in short, QIA's DNA was really set in the great financial crisis. So we're a very direct investment institution biased fund versus the other sovereign wealth funds. And since then, the fund evolved and created specialized sector teams. So we have healthcare, we have financial institutions, we have TMT, which I manage. We have, industrial sector team. The head is just sitting right there. So really very direct in nature. That's not to say that QIA does have a very active indirect team as well, and across different asset classes. But AI was dethroned, and I speak to a number of different people. AI has been dethroned in Davos, but it's still the number 2. And I think it's the theme that will remain as constant for the next few years. And that's because the rate of innovation has really been catalyzed. The industry was set up to serve cycles that span 5 to 8 years. Private companies innovate, they start eating up market share, there's a bit of M&A, and then there's an IPO moment, and then they become public companies, they continue to innovate and grow revenue, and then the cycle resets. What we are seeing now is this cycle has been really compressed. So 3 to 4 years, to the extent that some investors, like ourselves, are forced, in a good way, to start looking at companies much earlier than they used to. And this is important because the investments that we do today at late stage, on the late stage private equity, these are the companies that are now generating revenue, seeing scale. There are startups that are trying to out-innovate those companies. In the previous decade, that took 3 to 4 years. So investors had the time to realize returns, to see that IPO moment, and so on and so forth. But what we're seeing is everything is so fast-paced. Starting off within the TMT team, I used to have my first few years meeting investors. They used to wear ties. The tie is gone now. Yes, no one has the time. Everyone's focused. I'll give you another important anecdote of just the intensity of the competition, the innovation, I think the hard work that is going into AI world. For the first time in my 16 years in QIA, I've worked through the holiday, the last 2 weeks of December. There were processes that started, post-Christmas. There were literally those processes were targeting a first week of January close. So there's high intensity. There's definitely, talent density, but at the same time, talent shortage. So investors had to accommodate alongside this new environment, which basically means asset allocation, portfolio allocation is key. Specialized teams, understanding the technologies is key. I'm 39 years old. 6-7 years ago, I felt young versus the founders that I met. But now I'm starting to feel very old because I'm sitting with founders that are literally college dropouts. That theme continues to surprise us in a good way. But in the same time, what we're seeing is there are certain investors. So obviously, as a sovereign wealth fund, we don't have to go in the market raising capital. We don't have that complexity when it comes to our day-to-day business. Other funds see the pressure. The funds that had viewed the AI is overhyped, that underinvested across the AI opportunity set, starting from chips all the way to the application layer, they're feeling it now because they're in the market trying to raise capital, and they get the question, why have you underperformed? And the first answer that they give, and they should give, is that we were wrong. Yes, TBD, what happens from now, the next few years? Is there a big AI bubble that will pop? I don't think so. I think there's bubbliness caused by a bit of FOMO. There's bubbliness caused by investors that are not specialized enough, that are unable to understand these businesses and the sectors that they operate and the names that they're displacing. And there's also an element of, these are very young founders. These are first-time founders, intelligent individuals that are founding these companies. They are still not experienced enough to run the complexity of an organization, maintaining and retaining talent and growing their business beyond their home market. So it's a much more complex environment that investors have to navigate.
Yes, thank you for that overview. We should probably just drill into AI. It wouldn't be a Davos panel if we didn't. As you say, it has been temporarily usurped by geopolitics in this particular Davos, but it's still been the other conversation that I've been having. I mentioned the CFO panel that I chaired. I was interested that the discussion there was, and the subtext of our panel discussion is allocating capital for long-term productivity. They all seem to agree that short-term productivity uses of AI have been found. They've successfully allocated capital to that challenge, but fewer of them were seeing the revenue opportunities that AI might generate. Bettina, tell us a little bit what you're seeing, both within the companies that you deal with, which I know include a lot of the traditional Mittelstand German companies, but also internally in Commerzbank in the way in which you're using AI.
So if I start with our clients, and indeed, we are the bank for the medium-sized corporates in Germany called Mittelstand. They're actually not too much into AI yet. That is probably a fair assumption. That also has to do with a little bit being hesitant to invest. It's a little bit ties back what you said. They're a little bit more cautious. Really wanted to see how much value is in that, and then it's very much used for cost efficiency cases in the clients we see. For the bank, it's different, but I think also because we as financial institutions are in such a good position to make use of AI because we are absolutely data driven and we are super complex, also because of the regulatory environment. And these are two things where AI can really do benefits. And clearly we see it on the cost efficiency side. We do a lot of cost avoidance actually in the moment as we speak because of all the increasing requirements when it comes also to KYC and things like that. But we also see it, and that is important as a tool to increase staff satisfaction because we really clean up the tables of our colleagues of stuff they really do not like. And we clean up the tables of our relationship managers so that they can do much more meetings with clients, and that you can say is automatically transferring into revenue growth. And Commerzbank wants to grow its net commission income by yearly 7%, loan growth 8%. So we really need some capacity to do so. But what is also important, what we see is that it helps on the revenue side simply by we use AI in pricing very successfully. We use it to avoid negative revenues by avoiding fraud, which is a big theme in banking actually. And where we are the most cautious in the moment is when it comes to direct client interaction, which probably has to do a little bit with the specific of the German market, because we are less digitized as a country than many other countries. We still have a number of clients in our portfolio who still, it's hard to believe, I know, probably for this room, but we still have a number of clients who do not have any online credentials. So they do not use a mobile app, they don't use online banking, they purely go via our call centers and our branch network. That will automatically change over time because it's also a generational point. But that also gives a little bit the complexity that you can't make full use. So I think even that the midterm effects of AI are much higher, that we probably overestimate in the moment the short-term effects, but that we clearly underestimate the midterm effects of AI. And for us, the most important point and the priority for 2026 is, besides all the use cases we have as everybody else, is really making our staff familiar with this, have them feel comfortable with it. And that's you can do that best if they really see the value in it. For example, we use an agent assist for our call centers, and that is really a big support for them, because it's basically transcripting all the whole call with a client, providing automatic solutions for the problem, which is specifically good for junior people, and that's good for all, making an automatic transcript and a summary of 2-3 sentences, which then goes into the client history. So when the client calls next time, it pops up and automatically what happened in the last call. So things like that, and really digitizing our client is a key priority for us also for 2026.
Right, Rishi, to give us a little bit of insight into how you see your clients and indeed how OakNorth itself may be using AI here, and what are the challenges here in allocating capital in what, even if it's only a bubbly market, clearly there is risk in investing in a bubbly time.
I would say, the first thing I'd say is actually investing in AI is much less of a large investment decision than even investing in standard technology, because actually the speed at which you can actually get to product and get to impact is so much quicker. So when we think about the adoption of AI, and again, we've always been sort of technology first as an institution. And just to put that into context, 10-year-old business, we've sort of done 2 refreshes of our stack already, and now are probably halfway through the 3rd refresh of our stack. So we've always been quite nimble from that perspective, and the cost of actually experimenting with AI is so low that why not? And clearly, yes, we work in regulated environments, so there have to be guardrails of where and how. So if I break it down, we talked about efficiency. Efficiency clearly is, let's say, the easier aspect to get out of AI. And in certain areas, we've already driven about 40% efficiency gains. And for us, again, loan growth is like 30% plus a year. So in a way, that helps sort of manage how much you have to scale your teams to actually deal with that growth. The area which is then more challenging is to say, okay, how do you evolve your customer experience as a function of AI? How do you think out of the box in terms of actually delivering them something different, in the same way that, to use an obvious example, when we got smartphones, when Apple released the smartphone, you sort of said, like, what utility will I have for this? And over time, it clearly built. And if you think about where we are with AI and what's possible, the approaches and the customer experiences are going to evolve so much. And today, it's the native AI businesses, the startups, back to your point, where actually there's a lot of innovation in terms of what that experience could look like. So if I think in banking, I'll give a simple example. If you think about sort of people who are looking to save money and open savings accounts and looking for best rates, the approach today is either look at a newspaper or look at a aggregator online to actually identify who is sort of the top paying banks for what type of tenures, if you're looking to fix your money for a year, 2 years, 5 years, whatever it may be. You then push that forward and you say, could you actually envisage an agent who effectively understands what your spending behavior is, has a view on actually what your saving behavior and what your affordability of saving looks like, and is then always optimizing in the background in terms of actually the provision and the selection of actually where to put that money. Now, clearly, as a bank, that's not a good place to be, because fundamentally that just means you get more commoditized through that process. But that is an experience which clearly makes sense, and you can sort of see that coming into play. And then you take that like multiple steps forward, and you then say, okay, if you think about the experience that ultra high net worth individual gets with a private bank, and you break that down in terms of actually understanding the customer and understanding their needs, and then actually finding products, not necessarily just plain vanilla products, which actually work for that customer, that becomes something which again becomes feasible for everyone, right? The person who has 50,000 to save, or 500,000, or a million, and actually arguably even for the person who has a very large amount of capital, actually gets a very unbiased perspective in terms of actually how they can invest and deploy capital. So I think that the real disruption will come with changes in customer experience. And I would say that if I think about what all the talk around the AI is in Davos, at least, it is, at least from an enterprise perspective, it is still massively focused towards internal efficiency. And I do think that's just missing the actual big picture, because the innovation is happening by those native AI businesses which are rethinking the whole customer experience.
Right, yes, and that would lead to those revenue gains that these CFOs I mentioned are still yearning to see from the from the investments that they are trying to regulate and looking for returns on. Mohammed, let me come back to you. Just one last question within AI, but in this bubbliness, do you foresee there's going to be consolidation here? Is something similar going to happen with this bubbly AI phase as happened with the dot-com boom, for example?
No, I think there'll be winners and losers. I think that's the reality. We're already seeing this at certain parts of the AI opportunity set. One of the big winners, let's say, in the most mature AI application, other than the consumer side and the enterprise side, is in code generation. So Anthropic Code, Cloud Code is doing very well. I mean, we heard even Elon himself complimenting Cloud Code by saying that the new Grok model is reducing the gap between it on code generation and Cloud Code. So I think there'll be winners in different segments, and there'll be companies that fail. I think investors have to accommodate. Investors have to increase the number of investments beyond what they're used to, and maybe employ a barbell approach where you're putting a few kind of smaller bets on a few names that are promising, with the expectation some of them will be zeros, but making sure that you are doubling down on winners. And I think an important thing that we focus on is making sure that we have a seat on the cap table early, because the winners, the category winners, most of these rounds are oversubscribed. So making sure that you are early enough to be able to have at least your preemption option, and making sure that you have a relationship with the management team in order to secure yourself the allocation, I think is a very important focus within my team in QA.
Let me move on, because Bettina, usefully, you mentioned the areas defense, infrastructure, AI, and energy that were attracting attention for you and for German investors. The energy area, I mean, this is, but the shadow of Trump has fallen over energy. Let's face it, what he calls windmills, wind turbines are obviously out as far as he's concerned. But what impact do you think that's having on capital allocation decisions on energy in Germany or possibly wider Europe?
Well, first of all, I think it's important to note, and we all know that renewable energy is very important across all countries, including China and US. I think that is very important to note. I mean, there are difficulties which has less to do with the generation itself. It has more, in most of the time, to do with the infrastructure. When I take Germany, for example, we are not too bad in generating energy from renewable energy sources, but we are awful, and that is our biggest problem when it comes to distribute the energy. And that is our key problem specifically with renewable energy, because that is created at a place where we not necessarily need it. And we heavily are underinvested, and that is what the current government is changing together with the energy companies. We are heavily underinvested in the grids, in the infrastructure, and that is something we need to change as soon as possible. Because in the moment we have the situation, and the energy colleagues know that, we have the light and the dark days, and we currently have in Germany the problem that in dark days our energy prices explode, and in sunny days, so where you have a lot of sun and a lot of wind, they have the problem that they even have to pay people to take this energy, because otherwise we also have the problem that we are putting too much load on our infrastructure. And I mean, we have seen outages already. Think about what happened in Spain. There, most of the times, there are also other problems attached to it, but there is a danger in it. And so, what we really need to do, and this is also what we now do in Germany, as the part of the infrastructure package, is really investing in that. Investing also in production. That's also for sure, because we need even more energy, and unfortunately there was a decision about not having nuclear anymore, but we really need also more energy sources. But more pressing, short term at least, is really the infrastructure itself, and that's where a lot of investments go into, and that's the correct thing.
Yeah, so in fact, an overlap there with obviously the infrastructure priority, but also actually with the defense priority, because as you know well, in Germany, it was a vulnerability, that dependency on Russian gas, for example, and therefore
definitely, and I mean, energy is one of the why is Germany struggling in the moment, and also our some of our industry sectors struggling, and the key reason is because of the energy prices, because we have some energy intensive sectors who cannot operate really profitable in Germany, and the answer is that they go somewhere else where energy is cheaper, and therefore the whole investment into energy is super important. Besides the fact also that we know how it feels that if you can't protect, for example, your energy infrastructure. We had an attack in Berlin, and we had 4 days. There were 20,000 households without electricity. Not funny. In winter times was minus 10 degrees. I mean, ask the Ukraine people how they feel about it. But this is something, it's really something which is super important, and we need to invest much more. And the good thing is that the government the new government has really seen that, and it's doing a lot for that.
Yes, Rishi, I mean, feel free to pick up the energy and infrastructure points if you'd like to, but I'd quite like to hear from you also on, if we're sort of shading into geopolitics here a little. I'd like to hear whether you have invested in the US, you've acquired a bank in the US, so you've clearly got faith in that as a market that you can operate in. I'm just wondering again whether this shifting geopolitics is shifting allocation decisions more broadly, and what you see on that. But also feel free to pick up on any of the points Bettina's made.
Sure. Look, what I would say is that the US is still the deepest sort of single market, the largest capitalist market, the market which has the strongest entrepreneurial spirit across, and therefore when you go from Davos speak and sort of geopolitics down to scrappy entrepreneurship, right? You go to where the opportunities are, right? And therefore the US absolutely made sense and continues to make sense for us. I think that when you look at the geopolitics, given that we are bringing capital in, given that we are investing, given that we are lending to a segment of the market which is fundamentally underserved by community and regional banks in the US, which isn't touched by private credit, you've got a very strong positive story for the US, and therefore from our perspective, yes, the geopolitics is something which, how can I put it, a more benign environment sort of gives more comfort just because there's less moving variables, but I don't think that's something which has changed our mind or our conviction on focusing on the US. I think that the thing which one does step back on is actually thinking about how many countries now run such significant deficits. And if you actually take a longer time horizon, like what happens over a period of time in a lot of countries which are running these massive deficits in terms of currency and the like. But that's something which unfortunately exists across Europe, right? Across the UK for sure. So I think that's, some of my thoughts.
Yes, thank you. We've got about 10 minutes, and I'd like to make sure that I've taken some questions from the audience as well. So we'll just pause there and see if there are hands up for anyone who wants to ask a question to anyone on the panel or to the whole panel. There's two at the front here. Let's take two together, and then we'll see whether we get more. If you could say who you are and where you're from, that would be useful too. Thank you.
Good afternoon. Very interesting debate. I'm Andrei from Romania, macroeconomist. So I know the German economy. I'm following every day the US, Germany, China. 0.2 growth last year after 2 years of contraction, but investments, gross fixed capital formation contracting for 4 years in a row. So we need huge investments in Germany in order to go back to the level of gross fixed capital formation before the pandemic. How many years do you think we are going to see this recovery in terms of gross fixed capital formation, which is not only important for Germany, but also for the European Union economy? Thank you very much indeed.
Thank you. So just hold on to that question, and we'll take the second one at the front here.
Daniel, Geneva-based, a company called Markets Flare with a research consortium with Austria and Switzerland researching agentic AI in finance and banking specifically. So working with private banks onwards. And my question is going to bring you guys right back to AI. I'm sorry for that. But you mentioned one use case with the call centers and that kind of support. And the MIT just last year published a paper about a little bit of the bubbliness of enterprise-grade AI and how $40 billion are invested into enterprise-grade AI, and like 95% of those are generating little to absolutely zero value for these companies that are implementing it. So if there are some, what are the use cases where you've applied AI and you've actually seen a return or value on that application?
Okay, thank you. Well, Bettina, you want to take the first one, and then Mohammed, perhaps you take the second one, and I'll see if others want to respond.
Sure. So, I mean, when it comes to 2026, at least there will be more growth than 2025, that's for sure. Current estimates something around 1%. Our own research says 0.9%. That is not a lot. If you foresee that the stimulus itself will provide something around 0.8% to GDP, then one should know that it's an important thing in Germany is we have less holidays falling on a weekday and more on a weekend, no joke. That's does 0.4% increase of GDP just because of this fact. So you could
try that more often, possibly.
Yeah. I mean, I take Denmark. I mean, Denmark did the right thing. They just killed one holiday and had and financed substantial part of I think the defense with it. So it's probably also a good concept for Germany, but I don't know whether we can agree on that. But no, putting that aside, so that brings you already to a good number. And why you could now then ask why it's only 0.9% or 1%, and that has to do a little bit with the sentiment in the moment. We have a mixed bag in the sentiment. And we have a so-called multiplier, which the economists are, you know that, are applying. And this was last year when you looked at it midsummer, where people were much more bullish for 2026. It was above 1, now it's below 1, and that does the trick. And I think the important part, and that is then also defining how we will develop in the coming years, and that will have indeed an effect also on Europe, is will we see enough reforms and in the right pace at the German level, but also European level? So therefore, also the meeting they have at the EU Council level, 12th of February, will be pretty important, because it is very clear that we need more pace. We need more pace on the European level, but we also need more pace on the German level. My impression from the German government is that they are fully aware of it, that they are working very much on it, and I think it's also important to become a little bit better in the communication, because lots of things have been done, but not yet, they are not really seen, and you really need, it's all about sentiment. We all know that from our own corporates, from our corporations. If you have a positive momentum, you can do a lot, and and that's, I think, one of the reasons why the US is so awfully successful, because they are so self-confident and they really believe in themselves. And Europeans and also Germans, we are always looking on the things which are not working, on the challenges, instead of looking on the good things. So therefore, we need to have this positive sentiment and this conviction that we are moving in the right direction, that we really have everything together, and then we will also see the medium-sized corporates to start investing, because they are the ones who are currently missing in the equation. They still are cautious, and we need them, and then a sentiment will improve, and then you will see also much better growth rates, and that is what needs to be done, and it needs to be done actually probably even in the first half of 2026, so as soon as possible. But I'm very confident, because we have in Europe all the ingredients together. And also when I look on Germany, we have great research, we have great startups. People don't know that we have the highest number of startups ever last year, 2025, in Germany. Thousands of startups in Germany. We need to work on this scale up so that we're not losing them to the US, because they get the startup financing from us, and then they go for the scale-up financing, they go in the direction to the US, because it's becoming too large for European investors. That is something we need to work on. But we have a lot of things which should make us positive, and so therefore I'm very hopeful that it would not only be the 0.9% in 2026, and we could even achieve more, but I'm also confident that we will see more in the coming years if we do the things which are at the table.
Thank you. That's actually given me a bit of optimism that there's at least a pent-up possibility there. Mohammed, on AI, perhaps give us a couple of use cases that you can think of within QIA or QIA investments.
Sure. Maybe I address kind of the question very directly. I think put MIT, put billions in enterprise, and AI is failing. That's the best headline you can get, yes? Everyone's looking for kind of confirmation bias. But I think when I look at it from the perspective of the companies that we invested in, when I look at it from the perspective of the companies that we're contemplating investing in, and those are companies that we've met a year or 2 years ago that we've monitored. Revenue is expanding. They're landing and expanding. They're getting more logos. I think that revenue is real and it's sticky. We are in the first 3 years of this kind of AI paradigm shift. Enterprises were doing POCs, they were exploring. There are companies that ventured into a specific product vertical, that maybe didn't work as well. There's also AI readiness within these enterprises. So the devil is in the detail. I mean, my advice to everyone here is don't just go with the titles. Once that report is published, 2 months after, it's stale. Things have changed. But really, it's leadership at the top. So when we speak to all these companies that we have invested in and have engaged with, and I'll give you one example. I set my team to go and search for and map out the whole application layer in AI around 18 months ago. They came back and they were very excited with one company. And they said, this company is Crest AI. What does this company do? Basically, agentic AI in the call center. And I was like, guys, are you serious? My view was AI is going to totally displace the call center. Yes, why are we going and investing in an agentic AI company when there are other companies that are taking a more longer-term view by having a fully automated call center? Appreciate that when you go in and sell this to companies, a call center is dealing with basically the mainstream individuals. So everyone in society, everyone is different. Everyone, there's some tech-savvy people, there are some non-tech-savvy people. And appreciate that these are the companies that are going in. and are using the data to further improve the product and eventually will wholly automate that workload. I think that is key. So it depends on the decision made at the enterprise of what solution to engage with, and that depends on the different touch points. A call center is exposed to the public. A point solution within the enterprise that sits across a process is different. That's prime for AI use case. And we're seeing this through a number of investments that we made in companies that are focused in process automation. Yes, there was Celonis, for an example, a German company, one of the gems that exists in Europe. We're seeing traction in the US. We're seeing the names that they're displacing. And that's a testament that the product is evolving, the use case is evolving, and I think enterprises at the C-suite level are becoming more educated. So I'm sure in 2 to 3 years' time, MIT will publish another review and say, oh, well, maybe the initial use cases of AI were not as good, but there are a few use cases that have developed and have emerged that are actually generating a lot of savings, whether it's cost savings or revenue uplifts in these companies.
Thank you. We're nearly out of time, but I just wanted to ask Rishi to come in on something Bettina said, and maybe links also to the AI opportunities, which is that sort of danger of the startup moving to scale up and then just moving out of Europe, particularly, and going over to the more promising US market. Is that a problem? And if so, how does it get resolved so that everything is more balanced and Europe has the revival that Bettina hopes for?
So I think the comment made was around capital initially, but I'll address both. So I think around capital, the reality is the depth of capital in terms of for growth businesses is just much stronger in the US and actually out of the Middle East and out of Singapore, out of Japan, etc. So you just have these pockets of very deep capital for growth companies. And unfortunately, at the moment, I would say Europe doesn't have its own deep pocket for growth, for funding growth companies. So I think it's just natural that those scale up businesses actually do go and actually raise capital from those players, including QIA, clearly. So I think that in itself doesn't mean the business necessarily transports itself and becomes a non-European company, i.e. a US company, in Andrew, your example. But that then goes back to actually where is it easier to scale, right? Where is the opportunity? Where is the end client, enterprise, consumer, whatever it is, opportunity? And in a way, how many blocks are there to actually tapping that market? And I think the one thing in Europe is every market has its own idiosyncrasies, and therefore playing across is not necessarily, you can't have necessarily a homogenous approach to actually get there. Now, the US clearly has the same. I mean, every state has its own idiosyncrasies, but I'd say that the range there is much narrower than what you have across Europe. So I think that, again, I just go back to the same point, where does water flow easiest? And as an entrepreneur, you fundamentally want to go to those markets and venues where you actually can scale your business with the least friction.
Thank you. I'm going to have to wind up, unfortunately. I know there might be other questions in the room. I think some of our panelists will be around later if you want to approach them and ask directly. I just want to thank all our speakers this afternoon on this great and fascinating and hard to resolve topic. Mansour Al-Khattab for the Fireside Chat earlier, Rishi Khosla, Mohammed Al-Hardan, Bettina Orlopp. Please put your hands together to thank them, and thank you.